Let's get some insights on the news shaping the markets. For that, we welcome in Sam Stovall, Chief Investment Strategist at CFRA. Yesterday, we had record closes for the Dow and the S&P. In fact, the Dow was up over 700 points, its best day since June of 2023. So we've seen some excitement in the market. What do you make of the market right now? What's the big picture, Sam? Good morning.
Well, good morning, Nicole. Good to talk to you as always. I think the big picture is the increase in the likelihood that the Fed will start its rate cutting program in September. We had Fed Chair Powell report to Congress last week, and instead of saying, or I should say, he started off by saying he's not going to give any indication as to when they'll start to cut interest rates, but basically everything he said thereafter gave investors reason to believe that he will be cutting interest rates starting in September. Also, we had a much better than expected CPI reading and the beginning of Q2 earnings estimates, which right now are outpacing the estimate as of quarter end. So looks like this will be the 59th out of the last 61 quarters in which actual results have exceeded end of quarter estimates.
So with this, I mean, now we have this 100% likelihood that we will see these cuts, right? Now, everyone's betting now on September. Very interesting run in the small caps. I mean, everybody's been waiting a year and a day, right? A lifetime and a day for the small caps. And ta-da, here they are. Tell me a little bit about the rally that we've seen, but more importantly, what does it mean going forward for this group?
Sure. Well, I like to say that fundamentals tell you what, but technicals tell you when and how far. And from a fundamental perspective, mid and small cap stocks have been attractively valued for quite some time. We're recently trading at a 30% discount versus their 20-year relative PE. This is the mid caps. Small caps were at a 35% discount. So they looked very attractive. But investors seem to be saying, well, you know what? I'm going to wait until I get a better feeling that the Fed will be cutting rates, because if the Fed keeps rates higher for longer, too much longer, then that could throw us into a recession. And we do know that mid and small caps underperform during recessionary periods. So now that it seems as if the Fed will be cutting in September, I think investors are feeling comfortable enough that they can rotate into the mid and small cap arenas and take advantage of these very attractive relative valuations.
Yeah, so at this point, when you talk about valuations, and you made the point of small caps and how fairly valued they really are. Well, let's turn the corner here and take a look at the other side of the coin, and that's some of those tech names, some of the mega caps. Where do we stand on some of those, particularly in this election year?
Well, I think right now, I mean, tech, I think, looks a bit expensive. Our tech sector group head feels that valuations are 3 to 6 months ahead of where they really should be at this point. Primarily because of the momentum and the optimism coming from lower interest rates and the AI scenario. So our belief is we probably could end up seeing tech as market performer, maybe even a slight underperformer over the next 3 to 6 months. But we look to stocks on a 12-month basis. And so right now we are maintaining our overweight recommendation to tech and to communication services. Semis certainly look as if they could go through a mid-cycle correction, which is normal, but then recover. So our feeling is that we're not going to be downgrading any stocks at this point, because in our opinion, it would be foolish to try to time on a very short-term basis. We still believe they have very strong upside potential 12 plus months from now.
You know, what's interesting, as I mentioned, the election, you always have, if the incumbent is in and running, you know, you always have all those great details. But this was almost a really different, not historical type of comparison, because A, you have a former president running again, so he's not a newbie on the one side. And on the other side, there was talk of replacing President Joe Biden, in which case it wouldn't be an incumbent. It'd also be another face. You know, how were you handling trying to assess historically what this year could bring?
Well, that's a good question, Nicole. Historically, if the market rises between July 31 through October 31, then the incumbent person or party tends to get reelected, whereas conversely, a down market implies that the incumbent will be replaced. So this, in some ways, sort of reminds me of 1980, in which you had Jimmy Carter up for reelection. The market rose, yet he was replaced. We also had a third-party candidate in John Anderson, the way we have in RFK Jr. today. But when talking to our Washington Analysis Group, which is a political strategy group, they give President Trump at least a 60% likelihood of being reelected, and even have an above 50% likelihood that both houses of Congress swing to the Republican side. So I think that we could find that a rise would not be an implication that the president will be reelected, but that there will be a major shift, and investors are buying into it right now.
Yeah. All right. Sam Stovall, great to see you at CFRA. Thank you always for coming on and shedding some light on the recent action we're seeing on Wall Street. Sam
My
Stovall.
pleasure.
Thanks.
Thanks, Nicole.